markets. I'm looking at this chart here that shows all four of the major indexes, and you can see that over the past few weeks, they've had a strong upward trend. And just this past week, what we did was complete a bounce on that trend. So came down a little bit, and you can see all of them bounced up. The one that bounced up the strongest was the NASDAQ. But notice this chart here. This is the comparison between the S&P 500 on the top line up here, and then one below it is the volatility index. That's the pricing of options, which give us a prediction of how far or fast stock prices are going to move. When you have a bullish market, it should be the case that the VIX keeps going lower because they're sort of inversely correlated, right? Well, what we've seen over the past few months is that the S&P 500 index has indeed been trending higher, but the VIX has not been trending lower, at least not until these past couple of weeks. We made a brand new low. We kind of sat there, but this week we made a new high. So that's what the yellow arrow is pointing out. And it's kind of interesting. A new high on the VIX, but not a new low on the S&P 500. The fact that both of these are going up means we've got a divergence between the price of options and the price of stocks. That usually means there is more volatility up ahead. But in this case, it might not be volatility to the downside. It might actually be volatility to the upside. In other words, we could get some big moves up in U.S. stocks. If we look at this next chart, this is a comparison between the Aussie yen and the NASDAQ, which, as you've heard me say many times, I'm sure, that these two are usually highly correlated. They were anti-correlated for about a 1 or 2 month stretch over the summer, but they are coming back into correlation now. And you can see it here. This is a 30-minute chart of over the past week and just the price action over the past week. And we can see that we ran up, we ran down, kind of dipped early in the week and sort of leveled out. And then Friday, very clearly, right at the open of the U.S. market, up went both the currency pair and the NASDAQ 100. So that tells us that buyers have returned. Buyers are kind of ready to come back and bargain shop, buy up the dips, and so forth. I would expect, therefore, that through the coming week, we would see stocks on the rise, not just always straight up, but generally trending up, and some of them going up strongly. Let me show you which ones that I think might have the best chance. If I look at this chart, which has the various sectors, right? Each one of these is one of the sectors. E for energy, Y for consumer discretionary, right? And the B is basic materials. Those are the top three. As you can see, the energy sector is just sort of flat across the top, but the discretionary is ready to bounce, and the basic materials is already on the way up. So the basic materials play and the discretionary, why should both of those be going up at the same time? Well, because the discretionary sector right now is heavily influenced by a company by the name of Home Depot. They're the home improvement store, which really tends to benefit from inflationary news. Basic materials, that's the sector of stocks that make things that people use for construction projects and building and supplies for manufacturing of all kinds. That sector is heavily influenced by, yes, you got it, inflation. So there was a lot of inflation news this week that indicators and measures of inflation were higher than they've been in a long time. And so the U.S. is experiencing real inflation. And as a result, investors are responding by looking at sectors which tend to benefit from inflation. And right now, that's the consumer discretionary and basic materials. So what would that look like? Well, here's one chart that will show you kind of where the epicenter of all this is. This green line here represents the home builder industry. So people that are in the business of building residential homes, single-family homes in the United States, and people who sell products that those single-family home builders or owners would buy from, the home improvement stores, Home Depot, Lowe's, right, are trending up very strongly. As you can see, the green line is the whole industry to begin, collectively. But this chart up top, this is actually Home Depot. You can see Home Depot ran up during the month of October, has flattened out. Why have they flattened out? What's happening? Earnings are going to occur on Tuesday for Home Depot. So basically investors are saying, well, we don't know. We don't know what kind of quarter Home Depot probably had. We think it was pretty good, but we're not sure. So if the news comes out that Home Depot bested expectations, then you can bet that stock will jump and head higher and kind of resume the trend that these other stocks are on. Lind is the company that is the largest company in the basic materials sector, is on a very strong upward trend right along with the home builders. So if Home Depot comes back with good earnings report, you can bet that they will trend higher, sort of catching up with this trend. Yeah, they got out ahead of it a little bit, and the rest of the industry had to kind of catch up with them. But that's what's going to happen. It'll take off if the news is good. If the news is bad, it might affect all of these stocks. So we would see. If I had to guess, I would guess that the news will be good, better than expected for Home Depot. And why might that be? Well, if you look here at this chart here, we go to the currencies to look at it. Look at the chart right in the middle. The euro and the U.S. dollar, euro dropping, right? Big old drop early on or in the middle of the week, and then it's kind of slowing. But generally speaking, it's trending down. That's kind of strange because usually if a currency, in this case the US dollar, is showing inflationary tendencies, wouldn't it be the case that people would be less in demand of it? It's inflation, it's losing its purchasing power, right? What do we have here where we have clear signs of inflation in the US and in the US economy, and yet the dollar is strengthening? Now, it could be that is a huge warning signal that markets are getting ready to collapse and people are already moving money to cash and putting it there as a safe haven. I don't think that's what's going on. I think that what's happening is that the inflation in the U.S. is just signaling that the U.S. inflation is greater than U.S. inflation used to be. But inflation isn't just happening in the U.S., it's happening all over the world. And in the Eurozone, it's happening even more. And that's what we're seeing here is that, sure, the dollar is weakening, but the euro is weakening more than the dollar. So the comparison that makes this chart look like it's going down. But it's just the comparison of the euro to the U.S. dollar. You look over in the Australian dollar compared to the U.S. dollar, it did go down, but we got a pretty strong bounce on Friday. And I think that the fact that the Aussie has a little bit of strength and the euro basically has none means that my favorite pair, the euro Australian dollar, is probably ready for another leg down. And so that's why I wanted to show that chart. Last of all, I'll mention this chart. This is a comparison between IWC. It's an ETF that measures microcap stocks. Okay, I just completed a class this weekend on low-cost growth stocks. It was a great class. We had a great time. A lot of fun information shared there. But if you look at stocks that are micro-cap or small-cap and that are, potential big growers, when's the very best time to be getting into them? The answer is whenever this measure, IWC, divided by SPY. So it's the relative strength between the micro-caps and the large caps, right? Which one's doing better? If microcaps are doing better than the large caps, then that's people looking for opportunity. They're rolling the dice. And when money starts flowing into seeking opportunity, that's when you want to be trying to find those opportunities in low-cost growth stocks. So right now, we are, since the beginning of November, the past couple of weeks, we're up above that red line, the moving average of this relative strength measure. And as long as it continues trending up, it's still going to be a good time to go opportunity shopping. When it gets below, as it did in October, you kind of back off. You might still be opportunity shopping, just don't be so aggressive about it, right? So anyway, that's the situation we're in right now. And I think that what that means is through the coming week, there's still going to be some really good opportunities in the U.S. stock market. That's the weekend update for me, Gordon Scott.